Good afternoon. Welcome to this recording a different perspective podcast in front of the audience at Mellow at the Bend. I'm ʀɪᴄԳᴇʀ, and with me today I have the legendary ex-hedge fund manager, the market mystic, the asset capitalist Hugh Hendry, all the way from St. Bart's in the Caribbean. You are good.
I would emphasize X.
I thought it'd be good to start with a bit of conversation to you about macro and markets. And then we are very keen for audience participation. So we've got Hugh here for 40 minutes. So we're very happy to take any questions, all questions. And the more interactive we can make it, I think the more enjoyable it'll be for everyone. But Hugh, do you want to start with maybe talking a little bit about what we're seeing in markets at the moment?
No. I think it's a precursor, and I have to issue like a storm warning. I'm the asset capitalist, and that is my social brand. And what is asset capitalism? And it literally means if you want to see the future, you have to elevate your mind. Now, you don't necessarily have to take acid to elevate your mind, but I would emphasize three properties which I think they're actually just the same thing: playfulness, curiosity, and mischievous. I'm a mischievous person. I touch plates and sometimes they're hot, and so I don't touch them again. I also have to allude to the fact that I'm a Benjamin Button. I'm living my life in reverse. You are meeting the 21-year-old version. When I was 21, I was 65. I worked for Baillie Gifford in Edinburgh, and I was surrounded by old young men. I literally wore a three-piece suit. And I worked for a magnificent organization that did get me, and I didn't quite get there. And it was 8 years of misery. And it has to be said that if they had been less successful, they would have fired me. And then I went to London, and I worked with a fallen idol. I'm not sure what I can say, but I worked with Crispin Odey. And I was number 2 with Crispin. And actually, playfulness and curiosity and being mischievous does come from Crispin, but there are grades of that. And I do a podcast. I do many things, but I do a podcast, the Asset Capitalist podcast. And the last one I did, my point was, you and I, this room, this society, we could not build the pyramids. Yeah. And the reason is there is a great conceit and arrogance of modernity. And it passes from one generation to the next with the elevation of technology, that somehow we are superior to all those who came before. And when we're presented with a riddle, the majesty of the pyramids, the conceit demonstrates itself with these crackpot theories that it must have been an alien. There are extraterrestrials, and they came, they passed on secrets, and then they left. And what I want to get at is, before computers, before AI and possibly the singularity, we did extraordinary things. We built pyramids. Yeah? And we built it not with GPUs, we built it with imagination. And our imagination is so expansive that we can almost achieve anything. And what my little cabaret show is all about is trying to push back on too much process and stiffness in the financial affairs of other people's mind. Again, to see the future, you have to encompass some playful characteristics. You know, you have to employ imagination. And heavens, you need a lot of imagination to deal with what's happening, to answer your original question, and the markets today. And so very briefly, with markets today, we have the distinct odor of a bubble, clearly, in risk markets. And a bubble really is a compressed and very, very exciting cycle that it is compressed into a very, very short time period. And without the compression, because markets, risk assets they trend higher with prosperity. Prosperity is a constant. I mean, the young kids, I'm staying with my daughters, and they're at UCL, and there are signs for the Marxist takeover everywhere on campus. And indeed, at Stanford and Harvard, they are inviting the who's who of the greats of the private sector in America, being invited to these elite institutions to debate, we should ban billionaires. And of course, we've seen the election of the mayor in New York. We are clearly at a pivot. We're at a point of great, great social tension. The Dallas Fed, a chart emanated in the last 2 weeks, and the Dallas Fed they're clever. You know, these institutions have lots of PhDs, and beware the curse of PhDs. Again, that's the conceit. I think the Bank of England employs over 200 PhDs, and in the majesty of their wisdom, they were selling, as you know, in 2002. They completed the disposal of half of the British hoard of gold. The conceit and the arrogance of a well-formed argument. They sold, think of all of that gold accumulated through feast and famine and revolution and fighting Napoleon. That's Napoleon on now. He lost, tell him to go away. And it was sold to the conceit of the PhD. And I'm glad to say I was one of the plucky pirates that was the other side. I was buying it. With my first year as a hedge fund, gloat, or as an introduction, I made 50% in 2003 because I could see the winds of change. So I'm kind of someone who, it takes a lot. I ask and I demand a lot of you, but sometimes with pivots, the crazy people actually got to listen to it. Now back to the Dallas Fed and their PhDs, their best estimate of tomorrow has never been so, what I want to say, divisive. It's never been so winner takes all. The per capita income in America today is $50,000. So we take GDP and we divide it by all those American souls. And if the promise of the productivity et al. From AI succeeds, it will expand by tenfold. We will be very rich. And if we get a singularity and the machines become less obedient and they start killing us, we're dead. So we're either going to be 10 times richer or dead. Now, I'm actually not being playful. This is you know, the non-humorous PhD take. Now, if I come to you and say, I will make you 50-50 here, 10 times richer or dead, is anyone signing up for that? I'm not. And so you actually see the manifestation of that in consumer sentiment indices. And we've got acres of data on this stuff, 50, 60 years. Consumer sentiment in the US is below where it was in 1980. In 1980, the Fed pushed rates to 16% and forced a recession with the oil crisis. Having seen the previous oil crisis where we'd had the biggest decline in GDP since the Great Depression, that their reaction to the second one was to hike rates and bring it on. And we had massive, financial bankruptcies, etc. Consumer sentiment was stronger then than it is today. So we're confronted with a lot of uncertainty. I'm going to wrap and I'm going to try and answer the question. The challenge with a bubble, the challenge with investing is how you focus your time and your effort. So again, let me say something silly and then try and convince you that there's some intelligence to it. I am very proud that I achieved 15 years of tenure, that I survived for 15 years. Managing other people's money in my eclectic world was just the greatest joy. I woke up with passion and vigor until I didn't. I woke up, I didn't have the passion and the vigor. And I exercised, and my ambition was to be a world-class loser. Now you hear the Scottish accent, and the Scottish football team just won last night, so maybe we're breaking the stereotype, but be a world-class loser. What do I mean by that? You are confronted with making decisions on events which have yet to happen. You are going to make lots of mistakes. How's your game? How are you set up to be wrong? Because if your errors don't kill you, you are going to be the king or the queen in the rear. And that was my modus operandi. So within a bubble, work out how not to. I was fearless because I didn't fear being wrong. And I didn't fear being wrong because I'd already, if you will, set aside my strategy. Okay. So the challenge is size, because a bubble, I was saying this earlier, forgive me, but a bubble is Jesus. And you are buying into the singularity, which is going to make us richer. You're buying into Elon Musk's singularity. And that is divine-like, and its implications. But I am Jesus, and we're in the Garden of Gethsemane, that fateful night. And I turn to you all, and I say, you will reject me. And you say, but Jesus, like, you are the AI singularity. You're going to make me rich. I'm never selling you. I'm with you to the end. And Jesus slaps you, and the cock crows, and what have you done? You've rejected. So we are in a dynamic the last few days. The market's pulling back. And they're great qualitative stories that would convince you to get out. So make sure when the cock crows, make sure you've decided whether you're a believer or not. Because if you're selling when the cock crows, it's too late, that you lost out. So that requires size. And it also requires, I don't want to call it diversification. I want to call it the royal we. But I think of the world in terms of quadratic expressions. I don't, but I'm saying quadratic because I want to talk to you about the quadrants of global macro. That you should think of the division of your wealth as being separated into 4 components. And your weekly or your monthly, your quarterly task is to assign weightings to each of these 4 buckets. Now, I come from a dollar world, so my dollar world would be cash. I'm 5% on cash. I mean, any investment manager today, annual return should be underpinned with 4%. Cash never leaves your portfolio. You buy everything on margin. You pledge your cash earning 4%. You get 4, and you get credit to buy rising asset prices. So managers who are making 4 or 5 are just not in the game just now. That's just the cash, right? Now, cash would also be your choice of currency that you hold to denominate your wealth. You are here because you are franchised. You have assets. And you have a choice in terms of the division of currency to hold that. So that's the first quadrant. The second quadrant is the equity market. And it essentially is NASDAQ or S&P. Okay? The third quadrant would be fixed income. Would be your TLT. My God, TLT has destroyed me. Long duration US government bonds. Okay? And the one thing you should know there is we've had profound mean reversion. A very, very rare thing has happened. The long end of the United States bond market has halved in price. And when things half in price, people don't like it. Yeah. If any of the 4 pillars of my world fall 50 or 60%, I have to buy it. It's mean reversion. If a stock falls 50 or 60%, I don't have to buy it because there's idiosyncratic risk, which you don't have at the index level. So we have to consider that fixed income quadrant, okay? And then finally, and where all the fun is is in the universe of alternatives. And that's an enormous bucket of 150, 180 trillion dollars. Is private equity, is commercial property, is gold. And of course, it's the new crypto Bitcoin universe. And probably 5 things that I forgot. Okay. So, armed with quadrants, being conscious of size, and consciously trying to allocate your wealth between those buckets, who cares if it's a bubble? You've made yourself anti-fragile. So,
It was perfect. Before we open up to questions, I have one question for myself, actually. Historically, you've always talked about the fact you see rates going to zero. Is that something you still will see?
So I'm prevaricating because of how you presented that right at the end. Is it something I see? It's something, it's a view of the world which may happen. It may not happen. What my fascination with it today is, if it does happen, it is loaded with convexity. Which is to say, if it does happen, the pricing structure of the market has changed in the last 3 months or so, whereby the return on such strategies, which are option conceived and somewhat complicated, but you're talking about a return of 20 times your money. And if you offer me, what is better than great sex? 20 times your money. Forgive me for being vulgar, but if I can make 20 times my money, I'm playing. Okay. So now so it's important that I don't care about people's opinions. I care about the consequences of the opinion. And so there's a consequence of that opinion which can enrich all of us. Now we have to talk about the probability of it happening. And it's a very relevant question. We had Trump bad-mouthing the J-man again, pal, yesterday, calling him a very stupid man. He's not very stupid. And Trump is not very stupid. But there is a dynamic going on that you are not aware of. It's complicated. Let me see if I can simplify it. U.S. Treasury bonds, 10-year plus. I'm going to ask you, no one's going to answer, but would anyone dare tell me the size of the U.S. Treasury market, the duration size, like the bonds that have been issued, that are out there today, that have at least 10 years, that have 7.5 years plus of maturity to them? How many trillion dollars? A show of hands. 20 trillion. Who's 20 trillion? No, so no one's 20 trillion. 10 trillion. Do people have hands? Okay. Right. So, and I should qualify that the American economy is circa $30 trillion. And we know that debt to GDP is 1. And sometimes they misqualify and they bring in debt which is owned by one part of the US government agency to another. We don't count that. Right? But let's call it 30 trillion. So I think we had a quarter of the room saying 10 trillion. So that would lead me to believe that 3/4 of the room believe that there's really not a lot of treasurers. Is that you're telling me? Because I think there's a lot of, we keep hearing that we're drowning. Oh, so you think 40 trillion? There can't be 40 because I've just told you there's only 30. Anyway, shut up, B. There's 5 trillion. 5 trillion of 7-year plus treasuries in the world. And I want to tell you, that's not a lot. The gold market is presently capitalized at over 30 trillion. So the value of gold is 6 times the value of treasuries. But of course, you've got to buy gold. Okay. Now, let me tell you something more relevant. The principal risk asset, when treasuries, the risk-free, when it's so tiny, the principal risk asset is mortgage-backed securities. There are 13 trillion mortgage-backed securities sitting on the balance sheet of commercial city center banks. And margins are tiny, and those banks have to hedge interest rate risk. We've just gone through a period where the Federal Reserve went from 0 to 5.5%. Banks found the hedging of their book went completely to hell and back. And what the banks had to do in that environment was and it's convoluted, you have to trust me, I can explain it later. They had to control their risk, they had to short sell 10-year Treasury futures to hedge what was happening to their $13 trillion mortgage-backed security. They had to be pro-cyclical. We had inflation. We had every hedge fund manager in the world wishing to short sell treasuries. And we had pension funds giving up on 60-40 and selling physical. And then we had commercial banks engaged in the hedging of their mortgage business, short selling. There's a reason why bonds fell 50, but it never happens. We had a profound devastation in the risk-free market that you're not aware of. Okay. Now, what happened in 2020 and 21? There was a pandemic. Interest rates were very low. Long-term rates were very low. And everyone that had a pulse in America refinanced their debt. And everyone's mortgage, the 30-year, you could refinance your 30-year fixed at 3%. No one is moving home today in America. And Trump actually alluded to this in his nonsense yesterday. We want to help the housing market. Turnover has collapsed. Why? Why would you move house? You'd have to swap 3% fixed for 30 years for 6.5%. Not happening. Now, but what's interesting is we've never had such a concentration of a flashpoint that the entirety of the American private sector fixed at 3 in 2020, 2021. And my business is all about the impossible happening. What if the 10-year drops? What if it goes back to 50 basis points? Right? You will make it possible for refinancing. Now, so we're talking about rates going to 0. And I said to you, when rates went from 0 to 5.5, these gigantic institutions had to short sell. When the opposite happens, again, it's reflexive, pro-cyclical, and they're buying. So there are some convoluted options which make 20 times your money betting on 0 interest rates or rates below 1. The consensus, there's this notion of a natural rate, an R squared in the academic circles, where rates are doing no harm and no benefit, a neutral rate. And the policymakers have convinced themselves that it's 3, and the market has joined them in that belief. And so rates are supposed to converge to 3 by the end of next year. Now, Steve Murrell, who was the president's head of economic affairs and then was put on the board of the Federal Reserve, and he's the sole dissent. He's like, cut interest rates. And that's just because you're a Trump guy. He's the smartest guy in Wall Street. He's a modern day Keynes or Friedman in his understanding of what's happening in the world. And what he's seeing is that the model used by the 400 PhDs who work for the Federal Reserve is wrong. And it's being distorted by a profound concentration again of an event that you had the Biden administration say, come to America and become democratic voters. Yeah. And people came. And people came seeking the American dream. They came with very little. And with very little, the demand, the high yield credit risk stuff, that suddenly, like, people wanted. Like, they're the people you don't want to lend to. But, hedge funds will lend to you because you make a pretty penny. They're the people that buy the secondhand cars. They're the people who rent, right? Condominiums in communities are sitting empty. car parks are full of abandoned cars because another administration came in and said, get out. And and with force, with ice. And the people went, I'm getting out. What did you see? 10 days ago, CarMax, the largest reseller of secondhand cars, down 27% in a day. Those people are gone, right? So what Steve is saying is that when they were coming in, you got 30 years, the impact of 30 years of immigration concentrated into 3 years. And it's distorted your perception of where the neutral rate. Steve believes, and the Trump administration believes, the neutral rate is maybe 1. And the longer we fight resetting to 1, the more we might have to overcompensate and go to 0.
Amazing. Very keen to open the floor up to any questions. So if you can stick your hand up, and then Daniel will hand you the microphone. Please don't be shy.
Based on the interest rate curves there, could we talk about your path of what we're seeing there in the short term right now?
Short term, long term. Absolutely. So again, if you listen to my podcast, I'm going to try and navigate in the coming year some of the tricks. And there's just something you have, and I don't believe in complexity. Complexity corrupts. Complexity is conceit. Okay. The thing that's worked so well time and time again is a long-term price compression. Let me give an example. NASDAQ peaked in March 2000. Let's call it 5,000. 17 years later, it was at 5,000. 17 years and 6 months later, it was at 5,500. 18 years later, it was at 6,000. And today, it's gone up 5-fold. When you took out that price barrier, when a price barrier has existed for a very long period of time, it exists because the people who know it best, all these analysts, all these banks, all these great minds, it's impossible to get confident about tomorrow. And then something changes. And so I'm not Warren Buffett, God, but I believe in his sloth. The genius of God is he's sloth, or he or she is slothful. Like, let's not be in a hurry. Take our time, all right? So we don't have to be the expert, but expert opinion leaves its trail and its mark in financial markets. And if you're curious and you know what to look for, you piggyback on it. Okay, so if you had just been set up, if you'd heard my conversation here, and we go back in time, and you see NASDAQ taking out the high, what are you going to do? You're going to buy, and you're going to be 5 times the better. Okay, to your point, Japan, the broadest index in Japan, the TOPIX, did that this year, and it's been a long time going. Yeah, it was the last day of the 1980s when it was, it lasted these levels. Japanese equities, I would bet you would be 5 times greater in the next 10 years. Now, I know what you're going to say. Why? You're asking the wrong question. And it's your number one question. Why? Because you've got this monkey mind that's stopping your imagination. And I said, why does it not matter? Why did US stocks crash in October 1929? Why did NASDAQ peak in March 2000? Why did the S&P drop 20%, the Dow drop 20% in a day in October 87? Wait, there's no accepted answer. Why are you looking for answers? Silver. Yes. Silver's a loony. I mean, gold and silver are just stupid. Right. Now, when I say that, people get really angry. Like, they're emotionally invested, right? It doesn't know that you love it. You can actually call it names. Go really stupid, right? And silver is really, really, really stupid. I mean, gold is a monetary asset. Silver was a monetary asset, not a monetary asset. Okay. But Silver peaked in 1980. It's taken, 45 years. It's the longest compression ever. I hate silver, but I buy it. Of course I would buy it. I buy anything that's had a compression. Again, a story I shared earlier. Oil, I think it took 25 years for oil to breach $40. And it breached it at the dumbest time ever. It breached it in 2007. And I would stay at home. I lived in Notting Hill. I would stay at home. I'd listen to Pink Floyd. And I had programs like, so charts for me were, so charts are a small part of the exercise, of my mental exercise, right? And it's like sheet music. It stirs the curiosity within me. And I could see oil and a few other, I could see a pattern emerge. And I called my trading team, and so we took an initial position in Weir Group. Weir Group's British mid-cap Scottish business, and it makes pumps and valves for the extractive industries. And it makes 12% operating margin, good, like just properly managed. And they would occasionally make acquisitions, and so they would grow at 10%. The enterprise value to sales on that was 2.5 times sales. My team look at it like, we ain't going to make 3-4 times our money. There's no blue sky in this. And my guys were I'm the dumbest. I believe in principal and agent. I'm the principal, and I'm going to employ agents who are way smarter than me. They couldn't get it. Okay. I said to them, go back and put $80 as your oil price. Okay, I said, yeah, well, you made 3-4 times your money. I made 7 times my money. Right. So Japan has just done that. The currency, again, ask me why. I don't know. Currency is going to 200. If it goes to 200, probably goes to 300. That's kind of what the market's telling me. I could give you a kind of kooky theory why. You may be aware of the euro-dollar system. The euro-dollar system is the global matrix of private sector banks. And it creates more dollars than American regulated banks create. More dollars. It creates it offshore. It's unregulated. It's unleveraged. They make a lot of money. And the biggest offshore market is Japan. And the big tease was QE is going to be hyperinflationary. But for it to be hyperinflationary, banks had to be persuaded to take those reserves and go crazy. And the supposition that I have is they did it in Japan. And they did it via the euro-dollar market, where you could take $1 trillion yen, I don't know what $1 trillion yen is, but $1 trillion yen's equivalent of dollars, right? And you could go to your the underwriting window, which is really like the pawn shop. Got this, you got this big ring. How much will you give me for this? I've got these useless JGBs. And the guy says, JGBs, they're amazing. They never go down. No haircut. He'll give you the dollar equivalent. Okay? And so the problem is they're getting cold. They got naughty. And so I think Japan is, every evidence is stock market's going to go 5-fold higher and the currency is going to go to 300. I answered your question, but we're a very long way, sorry. And I probably killed the time.
Here we are, is wary of time. I think we're 5 minutes, but I think it'd be worth you mentioning maybe your Substack and maybe the asset capitalist Sarikam.
Yeah, so the next year will be the 4th year. So you will not be aware of the splendor and the joy of, say, Barts. I was the caricature of a Mayfair hedge fund manager. My children were in private school. I had to compete with the entirety of West London. I would sit in a Land Rover. I'd have a driver, and he would take me to my country shack in the Cotswolds. Why did I tell you that? Oh yeah, for the still what it's a nice thought. It's a nice thought. Summer camp. Yeah. What's that going to say? Was it the alpacas? Anyway, summer camp. West London. I was going to. Oh yes, no. I was the caricature. Yeah, and so I would vacation in the Caribbean in December, in Antigua, God forbid in Barbados, and these places. Caribbean is sketchy. And you stay in beautiful places, but there's a frontier, there's a security system. You don't go out. Yeah. Same bars. There are no Brits. It's going to be a good thing. We're looking for, like, we want diversity. And you've got that je ne sais quoi, the French thing. Beautiful French ladies. And you don't lock out. There's no crime. Zero crime. And there's zero tax. And I put on a camp once a year with 10 to 12 speakers. And it's a camp like no other. You stay in paradise. And we luxuriate. We have this formal thing, but it's breakfast, it's dinner, it's drinking, it's getting to know you. And maybe I'm going to do 2 next year, maybe one around about May, June, and the other one in mid-August. Put it in your calendar. The Substack is you get me every week. So you get the crazy guy. So you need the straight and the narrow, and then you need a little bit of titillation. I'm your titillation.
Hugh, this has been fantastic. Thank you very much. I assume you'll hang around for any further questions? Thank you very much, Shaw.